There we go. All right, welcome everybody. So great to see you all and have you. Oh, and Kern is joining us. Kern, we were just singing your praises. I think you have at least a half a dozen members on this call today. So you really
Good morning, Kern.
out of this one. We appreciate you.
Yay! Good morning, everybody.
Morning, Kern.
Morning.
So for those who, if I haven't met you yet, my name is Lisa Jordan. I'm the managing director of the IEA. And I'm the executive director of the Charlotte Executives Association. So all those Honolulu folks, I'm your Kern in Charlotte. That's what I do for Charlotte Exec. So happy to see you all here today. And I'm really excited to introduce our webinar speaker. But before I do that, I just want to draw your attention really quickly to my screen here. I'm just going to give a quick shout out for our next IEA event, in-person event, which is coming up September the 13th in sunny Florida. We're headed to visit a couple of chapters in Fort Lauderdale, Miami, and West Palm Beach. And our IEA board has put together a really fun day of golf and a social event, as well as a annual general meeting, which we'll be doing September 13th. This is open for all IEA members to attend. If you want more information, just go to IEAweb.com, click on conference, and then right there, that first option you'll see is a South Florida Golf and AGM. We have a great speaker planned. It's actually one of our members out of the Detroit chapter, and she is going to be talking to us on membership retention for our associations. So it should be a topic that is relevant to anyone who's in an executive association. And if you can't join us in person, I don't have a virtual golf set up, but we will have that speaker available virtually. So just like you're watching this webinar on Zoom, we will make that speaker session available on Zoom that day as well. So I hope you'll check your email and be on the lookout for that. So now I'm going to go ahead and change my screen and introduce our speaker, Tom. Tom DeLeo is a home equity retirement specialist. He's a member of the Executives Association of Long Beach. So they're on the West Coast. And Tom has been a mortgage professional for over 40 years, takes great care and pride in assisting his clients in understanding and selecting loan options that best fit their needs. He now specializes in providing reverse mortgages for clients 55 years of age and older. Reverse mortgages allow homeowners to borrow money based on the equity in their home. So we're excited to have you all on this webinar today. And like I said, I am recording it and it's going to be available on the IEA YouTube channel. So if you want to share this with a spouse or a client or employee or neighbor or friend, you can do that about by the end of the week. It'll be posted. So without further ado, take it away, Tom.
Thank you. Looking forward to meeting each of you. Want to make sure, can you see my shared screen?
Yes, we can see it.
Okay, perfect. As I go through the deck, feel free to reach out and ask any questions, something you don't understand. I'd be happy to answer the questions right while we're dealing with that part of the presentation. So let me start here right now. Just a quick survey. Do most of you understand or know anything about reverse mortgages?
You're getting some thumbs up and some thumbs down. So it looks like a mixed bag here.
Okay. Well, the surveys that we've taken show that most people fear running out of money during retirement more than they do actual debt. So we're finding that with inflation and what's going on in the economy right now, a lot of seniors who are either retiring or are retired have a lot of issues they're trying to deal with. So one of the options that is available to someone who's 62 years of age or older is looking at utilizing the equity available in their house. And oftentimes that breaks down into looking at what a reverse mortgage can do for them. Most people have a majority of their assets in the equity of their home. We found that 25% of the population have that are 55 or older have a good percentage of their net worth tied up in equity in their house. So would you like your clients to have a mortgage if they look like this? Doesn't leave any debt to the children, is a non-recourse loan. A non-recourse loan is a loan where only the property is utilized as collateral. If there were a situation where the loan could not be paid back, the lender would not go after any other collateral, just the home. Does not require monthly mortgage payments. They're not required, although they are optional. You can make mortgage payments on a reverse mortgage. Any money taken from a reverse mortgage is tax-free income. The reverse mortgage does not affect your Social Security or Medicare. A reverse mortgage can be paid off at any time without any prepayment penalty. Has no termination date. You can stay in your home as long as you are alive or haven't moved out for 1 year or more. So a reverse mortgage does not require monthly mortgage payments. It was created by Congress in the Reagan administration in 1988. Regulated by the U.S. government, Department of Housing and Urban Development. Insured by the Federal Housing Authority. Like I said, it's a non-recourse loan. Flexible borrowing terms that can be changed even after the loan funds. Bank, one of the misconceptions that we often deal with is the bank will take your house. The bank never takes title to your property. It's just like any other loan you have on your house right now in that regard. One of the things you must continue to pay are your property taxes, your insurance, and if it's a condo, your homeowners association dues. Once the loan is in place, the loan is secured by the home, not the homeowner's ability to pay. Neither the homeowner nor the heirs can owe more than the property is worth. Remaining equity in the house, if any, is the property of the owner or their heirs. The FHA insurance component is what covers the shortfall, if any. I'm going to stop right here and see if anybody's at the point where they have any questions on what I've gone over so far. Everybody's good?
I think
All right,
so.
I'll take it.
Feel free to put stuff in the chat if you want. We'll keep an eye on that too, if that's easier for everyone.
Okay. The homeowner is never required to make a payment on the principal or interest until the last participant dies, moves, or sells. The HECM loan is offered for as long as at least one of the borrowers resides in the home as their primary residence. If one of the borrowers goes to the nursing home for good, it does not affect the loan as long as the other borrower is still living in the home. If the last remaining borrower leaves the home for a year, presumed no longer to be the primary residence, the loan becomes due. So one of the important things is a homeowner cannot outlive his loan, even if all the money available has been used. The homeowner cannot be forced from the home unless homeowner's obligations are not met. So if all the equities got used up and you're still living in the home, you've utilized the entire line of credit. As long as you're paying your property taxes, your insurance, maintaining the property, you cannot be forced to leave the home. Who's eligible for a HECM? HECM stands for Home Equity Conversion Mortgage. That's where we convert a portion of your equity into a loan. Homeowners are willing and capable of maintaining a home, taxes and insurance. The home is their primary residence. Homeowners wishing to buy a new primary residence has 50 to 60% as a down payment. The reverse mortgage also works on a purchase, whether you're wanting to upsize, downsize. What a reverse mortgage allows you to do is purchase a home, condo, townhome with no monthly payments. A reverse mortgage can be done for someone who is 62 and has a spouse who is younger than 62. There are special safeguards that are put in place for just that situation. So some of you may be asking, why take out a reverse mortgage versus a home equity line of credit? Okay. If anyone remembers back to 2008 when home equity lines of credit were frozen and the loan was started to amortize, payments shot up dramatically. A HECM loan cannot be canceled. It's guaranteed by the US government, so it cannot be canceled.
Hey, Tom, we do have a couple of questions.
Okay,
What does the loan becomes due mean?
loan becomes due when the last remaining borrower sells the home, passes away, or moves out of the home for a year or more.
Okay,
So
and then, oh, okay, go ahead.
I was going to say, so in a situation where maybe the husband passed away and 5 years later, the wife passes away, now the home goes to the heirs and the heirs decide what they want to do with the home. They can sell it, they can refinance it, or they can buy it for 95% of whatever the loan amount is.
Gotcha. And then the second question is, do multiple participants need to be on the title of the house?
Only the homeowners. If you own a home with a husband and wife, they need to be on title if they want to be. If it's in a trust, we will lend to a trust. All we need to do is review the trust. But like I said earlier, one of the borrowers needs to be 62 years of age or older on the HECM loan.
So, Tom, if the children of the homeowners want to be on the title and be qualified for the HECM loan, that child has to be 65 or older. Is that correct?
Generally, it's not a good idea to have your children on title. Yeah, I'm not an attorney or a tax consultant, but I've done this long enough that it's typically not a good idea to have your children on title for a number of reasons. If one of your children is not 62 years old, but they are on title, depending on how old they are, if you're 90 and they're 62 or 61, because we use the age of the youngest borrower. So if they're pretty close to 62, you could probably still qualify if you have a lot of equity. But if you're 62 and they're 40, using their age, there's probably, unless you own it free and clear, probably not enough equity to do a reverse mortgage.
Okay, thank you.
All righty. The money that you pull from a reverse mortgage can be used for anything you want. On an equity line of credit, usually there's a interest-only payment for the first 10 years. After 10 years, it becomes amortized over the remaining 20 years. So if you were paying interest only for the first 10 years, your payment could jump drastically in the 10th year as the loan begins to amortize. on a reverse mortgage, a payment is never required. Reverse mortgages the requirements are very, very minimal as to income and credit. We don't use FICO scores. We do require decent credit, but we will review that. But it's absolute minimal income and minimum credit requirements as to a home equity line of credit. The loan is guaranteed by the U.S. government so that no matter what happens to the lender, all of the conditions of the loan are provided and covered so that you don't ever have to worry about if you do a loan with the line of credit, it being canceled. So one of the things we get into is typically when people are retired and no longer working, they're pulling money from their retirement funds, IRAs, 401ks, selling stock, maybe they have a small pension. This part of the deck gets a little bit complicated unless maybe you have a financial planning background. So I'm going to kind of go through it quickly and explain what it is. You have a source of funds being your retirement funds. Last year and a half, the stock market, bond market, those things have not been performing very well. So it probably is not the best time in the world to be pulling money, selling stocks, and getting out of the market. Over time, the market generally comes back. So during those times, it's better maybe to pull some equity out of your house and start using that equity and let the retirement funds build themselves back up so that they have time to recover. Because over the lifespan of 30 or 40 years, the stock market tends to always recover. So we call that what's called in the business, and if you deal with your financial planner, it's called sequence of return. Taking money from your home when it's probably not the best time to take money from your investments. So this chart here, if you look at it, it goes back historically from 1973 to the year 2000. Starting with an investment portfolio of $500,000. On the left is if the people did not pull equity from their home, they just pulled equity from their retirement accounts. You would see at the end of the 30-year cycle, these people would have no money remaining in their account. Okay. If you look at the right-hand side, same scenario, same year, same everything else. But if the investors were to pull some money out of their home during a down market to let the stock market recover, at the end of the same period, they would have a little over $1 million still remaining. So it's better during down stock market times to let your money ride. Don't panic. Don't sell all your money. Don't sell all your stocks, and let the stocks recover, because historically they always have. Does anyone have any questions here? I know sometimes this is get a little bit difficult to understand. We're good?
One question, is there an interest payment on the loan and how is it calculated?
Interest payment on a reverse mortgage? There's interest charged on a reverse mortgage, and I'll get to that, but there is never a payment required. Okay. One of the things that people don't really understand is once the loan is made, the value of the property becomes insignificant. So if you borrowed a reverse mortgage when your home value was $500,000 and you borrowed $200,000, let's say, if you took out the line of credit keeps getting bigger and bigger and bigger and bigger and bigger every year. Okay, and I'll get into that. But let's just take the case of 2008, when you borrowed, your home was worth $500,000, and in 2010, your house was worth $250,000. But you borrowed $200,000, and maybe that has now grown to $250,000. Your house could keep going down in value, and the line of credit of available funds to you would keep growing, irregardless of the value of the home. So in 15, and I'll show you that when we get to that point. So there's no more questions on this portion. I'll go to the next slide in the deck. So this is where I'm talking about the line of credit growing. If you took out $200,000 line of credit, right now the lines of credit are growing at about 8% a year. So it would be worth about $216,000, and then keep growing from there. So that each year as you age, you have more and more money available to you. Like I say, and that's non-respective to the value of the house. The value of the house could go down. You would still have a growing line of credit. That's certainly not true in a home equity line of credit. Under those circumstances, if you had a HELOC, home equity line of credit, your bank would probably cancel it on you and start the amortization so that your monthly payment would go up dramatically. The HECM line of credit cannot be canceled, can't be frozen, and it cannot be reduced. So most of the borrowers fall into basically 3 or 4 categories that I've witnessed over the life of the loan. Some people need an extra $1,000, $1,500 a month really to stay in their home. Okay. Some people never took out long-term care insurance. So if there's an illness, I've done a lot of loans where maybe the husband has had a stroke, the wife has Alzheimer's, they need to bring in-home care. Every state's different, but I know in California, it's pretty darn expensive to get in-home care. So they've used the reverse mortgage and the line of credit to pay for the in-home care. It's your money. You can spend it however you wish. Or not spend it. Some people have done a reverse mortgage with a very, very, very low loan. They own their house free and clear. They maybe take out a $20,000 or $30,000 loan. They put a $300,000 or $400,000 line of credit, and they just sit there and watch it grow year after year. They're paying no interest on that line of credit. Should they need emergency funds, it's sitting there waiting for them if they need it. If they never need it, they never have to draw it. So how do we determine how much money we will lend? We take the value of the home, we take the expected interest rate, we take the age of the youngest borrower. Okay, that will tell us how much we're able to lend. In most cases, we're able to either eliminate the existing mortgage and supply a line of credit if that's the product they choose. If they choose the fixed rate, there is no line of credit available. They choose the adjustable rate and there's equity available, then they can do a line of credit. On a reverse mortgage, about 2% of the loans written are fixed rates. About 98% of the loans are adjustable loans. So here's what we do when someone is interested in getting information on a reverse mortgage. We provide a proposal. And here's what the proposal looks like. I don't know if you can read it or not, but what it does is it lays out all of the numbers so that they have no surprises. In this case here, the home value is $200,000. The principal limit is 113. Principal limit is how much, based on their age, the interest rate, and the value of the house, we're able to lend to them. Okay. We take out all, in this scenario, they had a $25,000 mortgage. So after taking out the costs and paying off their $25,000 loan, they have a $77,000 available to them. In this instance, they used it and can use it as a line of credit. Okay. This is an amortization schedule, and this is one of the most important pieces of paper that we show to analyze how potentially a reverse mortgage could work for a borrower. I don't know if you can read that. Can anybody read that?
The print's a bit small. We do have another question
Okay.
in the chat. Who determines if it's adjustable rate or fixed, the owner or the lender?
The owner. You get an example of how each one works, and depending on what your goals are, you can decide, and we can show you and work out what would probably be the best product for you. So, for instance, if your goal was to accumulate funds as you age, so in this borrower's, they started out at 76 years old. Okay, and by the time 13 years passed and they were 88 years old, their line of credit has grown from $345,000 to $484,000. So they would have that money available to them no matter what happened to the value of their house. So if they had an emergency, if they had an opportunity to buy something, for whatever the reason they decided, I need some money, they could take part of it, they could take all of it. It's totally up to them. So if you're, say, 70 years old and you have maybe $400,000 or $500,000 in a retirement account, and you owe a couple $100,000 on your house, we could pay off your house. You never have to make another mortgage payment, so you could save yourself maybe $1,500 a month. You set up this line of credit, and by the time you're in your 80s, when you potentially could need some money for either health care, or you want to take a vacation, or whatever you want to do, there could be a considerable amount of money still available to them. So that is one of the huge benefits of a reverse mortgage.
Another question from Ron here. We have a disabled adult son. Do they do a home inspection, or is the value based on comps in the area?
They do a full-on appraisal. They will come out and appraise your house. Depending on the product, some cases they may require 2 appraisals. But they do a complete appraisal, and the appraisal costs, depending on the value of your house, usually from about $500 to $800, depending on the value of your house. Okay. Here's some examples. Pretty much spells it out. This person was 65, had a mortgage payment of about almost $1,300 a month. They took out a reverse mortgage that we did away with that payment. So they no longer had to make a payment. In addition, they had a line of credit of almost $100,000. Out-of-pocket expenses. What does it cost to originate a reverse mortgage? Out-of-pocket is between $125 and $175, and that's for the federally licensed counselor. All senior citizens who take out a reverse mortgage must go through about 45 minutes to 50-minute on the phone counseling session, where they are counseled as to, are they mentally capable of making this decision? Do they understand the loan? Does everything that the loan officer told them, is it true and correct? So what you'll find is this is the most regulated mortgage loan available in the country. It's highly regulated because they don't want anyone taking advantage of senior citizens. So we want to make sure they're competent. We want to make sure that no one's forcing them to do this. And we want to make sure that they're educated and have correct information, so that that moving forward, they know exactly what they're doing and what's happening.
Tom, another question. How does it work if decided to start an estate after the HECM is done?
After the what?
It says HECM.
I'm not sure what they're referring to.
Yeah, I was thinking home equity. Bob, you want to chime in there with your question? Well, all right. If you'd like to, feel free, but keep rolling, Tom.
How it works is, if this answers your question, once someone has an interest in a reverse mortgage, I give them the proposal. They say, okay, yes, I'd like to move forward with this. So I give them a copy of at least 10 counselors. I'm not allowed to direct them to any counselor. They pick the counselor, they go through counseling. Each state has a little bit different time frame. Here in California, we have what's called the 7-day waiting period. So they get the proposal, they call their counselor, the counselor's date is set. The set date on the counseling, when they take the counseling, I must wait 7 days. After the end of 7 days, I can then take the loan application. So during that 7 days, I usually collect what documents I need. A short set of documents, really. On the 8th day, I ask them, are you still wanting to move forward? They say yes or no. If they are, then I take the application. We take the application, we go through the paperwork. It looks like yes, they're probably going to qualify. We ask them again, do you want to move forward? They say yes or no. This has cost them nothing at this point other than the counseling fee. There is money available right now. I've had most of the clients I've dealt with recently have had the counseling done for free because the government has made funds available. So they haven't paid, typically they haven't paid anything at this point. They say, yes, I want to move forward. The appraisal is ordered. Appraiser calls the client and sets up a date that's convenient in time and comes by the house and does the appraisal. They pay the appraiser directly. So that does not come to the lender, it goes directly to the appraiser. Okay, and we take the appraisal, the paperwork, go through underwriting. The customer is then asked, do they want to continue? If they say yes, we go to loan documents. Loan documents are then signed. At signing, the client has another 3 days in which they want to decide, do they want to keep moving forward or do they want to cancel? After, on the 4th day, if they have not canceled, the loan funds. Typically, we can do a reverse mortgage if the borrower sends us the paperwork we need within 30 days. So there are a number of safeguards built in during those 30 days so that the client does not have to spend any money and is really not obligated to move forward.
Tom, so a clarification from Bob, how does it work if decided to start an estate after the reverse mortgage is done, is what it sounds like he's asking.
You want to start a reverse mortgage after reverse mortgage is done?
He says yes.
Well, that would be a refinance.
Oh, okay.
If you already have a reverse mortgage and you want to do another one, generally a year must have passed. And then we have to improve the existing mortgage by at least 3 requirements. And so we have to make sure that it is a benefit to the borrower. Otherwise, we cannot move forward. So if you know, I do refinances all the time. Somebody took out a reverse mortgage 10 years ago and wants to refinance it. We go through a scenario where we make sure that we're improving their situation from where it was with the original reverse mortgage, and then we're allowed to go forward. Does that answer the question?
Bob says no, start an estate after the reverse mortgage done.
No,
Tom, let me try and clarify that. I think what Bob is meaning is that if you start a reverse mortgage before you start a trust or an estate that you put the trust, you put the house into the trust. You mentioned earlier that if you already have a reverse mortgage in the trust, or you can actually do that in a trust. Is that correct? I was told you can't.
no, we close reverse mortgages all the time, every day in the trust. You do not have to take it out of the trust and put it back in the trust. If it's in the trust, when you come to me to do an application, all I do is get a copy of the trust and have our attorney review it. But in fact, if I work with a client whose property is not in a trust, I always tell them, please look at putting it into a trust, because you do not want to go through probate. Probate is very, very expensive. With what's gone on with the pandemic in California, it could take 18 months. So your heirs would have to wait until probate was done to inherit the property. A trust is the preferred way of holding title to a property.
Okay, thanks, Tom. I don't know if that answers Bob's question.
No.
No? Bob, I'd be happy to talk to you directly if you want to ask me the question. Want to make sure it gets answered for you.
Yeah, feel free to unmute Bob and chime in. In the meantime, we have another question from Kelly. The pros of a reverse mortgage sound very intriguing. What are some cons?
Cons of a reverse mortgage is that you are utilizing the equity in your home and you're paying interest on the money you've borrowed, so that each month you're eating a little more of your equity away. That's one of the cons. So what I get as a con sometimes is I want to leave my children a legacy. I want to leave them money. So typically in a reverse mortgage, we use a 4% appreciation. Certainly in the last 2 years in California, the properties have been going up by probably 20%, but that's not going to continue forever. And sometimes a house may go down in value. So we use a 4% appreciation. So you see over a 4-year period of time, a house keeps appreciating. You still own the house. If you go back to that one slide, if you look at the last column, I don't know if you can see that. but the property value keeps, we like I say, 4% appreciation. So the equity remaining in the home in this example continues to rise. Okay, so if you have a portfolio of $500,000 and you start taking money out of it, and the interest that you're earning on that portfolio investment is not rising faster than the money you're taking out, that portfolio is dropping. Okay, so even as it begins to recover, it's recovering on a lower dollar amount. So you start out with 5, and maybe after a year, because you lost 20%, you now have, 490 or 480. Whereas a home, the appreciation on the 4% is on the value of the home. So if that continues to go up, you can see that this borrower at the age of 83, with the reverse mortgage, never after making a payment, is still have $1.2 million in equity in their house. So their children would inherit, if they passed away at that time, would inherit $1.2 million to decide what they do. Where maybe their investments started at 5, but because it kept chipping away and chipping away and chipping away, it may be down to 300. That's where I showed you the sequence of return. Those are the things we discuss when we go through a proposal. And oftentimes, one of the referral sources I use are financial planners, financial attorneys, CPAs. They're often in on the discussions with the client, so they see what is the best way for them to go. But the negative of a reverse mortgage is you're paying interest and not making any payments. So that interest is accumulating. It's growing. You can see in the scenario here, in the first year, these people paid, the interest, and the loan balance keeps growing. The same when they're 88 years old, their loan balance started at 121,000. Their loan balance is now 170,000 because they've lived here from the age of 75 to the age of 83, 88, and have made no payments. So their loan balance is growing. Okay. Okay, so the options on how to take money from a reverse mortgage. You can take a lump sum. So if you on a fixed rate, that is really the only way you can take money, is a lump sum. So that's why the fixed rate reverse mortgage is not too popular. If you were able to take $500,000 of a reverse mortgage, you'd have to, on a fixed rate, you'd have to take all of it. Okay, and you start paying interest on what you take out immediately. So unless you had some a need for $500,000 immediately, it would not make any sense to take that amount of money out, because you'd start paying interest immediately. A tenured payment is, you tell me how much money you want a month forever, for as long as you're alive. I don't care if the house goes down in value. I don't care about what. As long as you're alive, you're going to get a tenured payment of X amount of dollars. Now, when we do that, that's based on what's available at the time. So maybe $2,000 a month for your predicted life expectancy is $2,000 a month, and you get that for as long as you live. The life expectancy that we use in a reverse mortgage is 99 years of age. So you could take it out at 65, and live to 99 and get $2,000 a month for as long as you live. So, a term payment. Term payment is calculated by how much money is available for making the loan divided by the number of months. So maybe you want more money, so you get $5,000 a month, but you only get it for 15 years because essentially you've run out of available funds. Once you've used all of that money, you cannot be kicked out of your house. You stay in your house as long as you want to. You still have to pay your property taxes and your insurance, but because essentially you've utilized your portion of the equity at that point, you cannot be forced to leave your home. The line of credit is probably the largest loan that we do, where depending on the need, somebody pays off their first, maybe takes out a little bit of money, and we put the rest in a line of credit. And the adjustable loan, even after the loan funds, say in a year, you said you wanted $1,000 a month and you decided you really don't need it because now you're not making a house payment. You don't need that extra $1,000. So you just send in a request and say, stop sending me $1,000. It starts to now accumulate in your line of credit. So in a year or two or whenever you need it, that money has grown more and more and more. It's still available for you. Okay. Maybe you win the lottery and all of a sudden you got excess money. And so you say, I don't want any more money, but I want to keep the line of credit, but I want to start making monthly payments. So for every dollar of monthly payment you make goes to the line of credit. So if you're making $1,500 a month, or let's say $1,300 a month in a year, your line of credit could grow by almost another $15,000 plus compounding on the rate of growth. So it's totally flexible and you can change that whenever you want. That's up to you, provided you take the adjustable loan. Okay, HECM for purchase, that's pretty much similar to the reverse for refinancing your existing home. It was established in 2009, and you want to downsize your house. You live in a $800,000 house with 4 bedrooms and 3 bathrooms on 2 floors, and you want to move by your grandkids to a 1-story house with 2 bedrooms. So you're going from an $800,000 house to a $400,000 house. You sell your house, you come out with $600,000 in equity. Why put it all down on the house? Buy the house with a reverse mortgage, put 60% of it down, put the rest in the bank, put the rest in wherever you want to use it, and use the reverse mortgage to purchase the new house, put money in the bank or wherever you want, and never have a house payment. So that's how a reverse for purchase is utilized. These are good for single-family homes, multifamily up to 4 units, as long as the borrowers are living in one of the units, for condominiums, new construction, or modular homes. This loan has become more and more popular, I'd say, in the last 6 or 7 months. Up until interest rates started to move up a little bit, and properties were selling at above asking with 1 day on the market, the reverse mortgage for purchase was not as popular a product. I probably did 3 or 4 of those last year. I've already got 5 going so far this year because it's become a much more popular product.
Tom, you may have already answered this, but do you have to pay off the first when doing a reverse mortgage?
We pay off the first for you.
Okay.
Okay. Yeah. A reverse mortgage is in first position. So if you have an existing mortgage that you're paying on, we eliminate that payment by paying off the first. Okay, another area where a reverse mortgage is used is in gray divorce, where one of the divorced persons want to stay in the house. The other person can buy out the other person by using a reverse mortgage. The other spouse goes and purchases another house, maybe with a reverse mortgage. So one can stay in the house and not have a payment. The other can buy another property and not have a payment. So we work with divorce attorneys, family planning attorneys. We work with realtors all the time. That's really where our business comes from. So that really brings it into the presentation. If anyone has any questions at all, I can give out my email address. It's tdeleo@mutualmortgage.com.
Tom, can you paste it in the chat maybe?
Sure, I can do that.
Copy and paste in there because we did have a couple people ask for your contact information so they could reach out afterwards if they had any questions.
Okay. I noticed that we have a lot of people from Hawaii. We have a loan office in Oahu. We have 3 loan officers that take care of Hawaii. So if anyone wants any information on Hawaii, just send me an email, and I'll be happy to forward your information onto our office in Hawaii so that you can get whatever information you need.
Hey, Tom, Kelly Griffin here. I was the guy who asked about the cons earlier, and I guess all of this does sound intriguing, but I'm just wondering what you would say has caused what I perceive as a historical stigma, negative stigma about reverse mortgages for a long time. You know, you see Tom Selleck on the TV spot, and you hear people kind of, you know, you hear comedians reference it once in a while and stuff, and I'm just wondering where that comes from.
It comes from lack of correct information. It comes from the neighbor down the street who heard something from somebody at church who said, "Oh, don't take a reverse mortgage. It's the last resort. It's scary. It's, you know, do you need it? The bank's going to take away your house." None of that's true. We have proprietary reverse mortgages that lend up to $4 million. And that's a $10 million house will lend up to $4 million. I have multimillionaires who do reverse mortgages only because they're very financially sophisticated, and they realize sitting on $1 million or $2 sitting dead in their house where they can't utilize it makes no economic sense at all. They know what to do with their money. So I recently did a very famous Hollywood producer. I did a reverse mortgage for him. By no means did he need the money, but he knew what to do with it. I've done probably attorneys that people who know that. I've done their loans. Like I say, sophisticated people, they know that they look differently on money than people who maybe have a $500,000 house and that's their major asset, and they feel secure at night knowing their house is paid off. Probably.
Do you have a reverse mortgage?
I don't have a reverse mortgage because I build houses. So if I probably have never stayed in a house more than 2 or 3 years. In fact, right now I'm 2 years behind on my last one because of COVID. So Me and by education, I received my degree in architecture, and my wife's a realtor, and probably in the last 15 years, we've done 10 houses. So, but I would have a reverse, I would put a reverse, if my parents were alive, I'd put a reverse mortgage on their house, if they wanted and needed it. But I don't myself, because I don't stay in a house long enough for it to make sense. If you're gonna stay in a house 3 or 4 years, I highly recommend you don't take out a reverse mortgage, because it does not make sense. But if this is a home you plan on staying in for 5 years or more, definitely take out a reverse mortgage, or at least get informed and educated. That's always how I present it, is become educated. And if it makes sense for you, yeah. If it doesn't make sense, don't do it.
I'm intrigued by that reverse mortgage for purchase, because yeah, it's just my wife and me in this place that's too big for us now, but so we're looking to downsize, but I'd also be interested in thinking of it as, you know, the last place we'll ever get, and kind of cash in all the chips at the finish line, you know?
But in the scenario that you just described, you would be a perfect candidate to get educated and really take a hard look. You may decide, you know, this doesn't make sense for me. I'm gonna pay cash for my new house, but at least you would be able to make an educated decision.
Yeah.
So that's kind of how we look at it.
Well, the other issue I've been struggling with is, you know, I don't want to leave a pile of money to my kids. I mean, I've worked to make the pile. I want to use it.
Yeah, absolutely. You know, I like that. See, with the motorhome going down the street with the license plate says, I'm spending my kids' inheritance.
Yeah.
But, you know, I see that all the time. People want to, you know, you work 30, 40, 50 years, however long you work, go enjoy life.
I want to die penniless and call it perfect timing.
Well, you're a good candidate to look at a reverse mortgage. Absolutely. Where do you live?
I'm just south of Portland, Oregon.
Portland, Oregon.
I'm not in Hawaii.
Okay, well, we have an office there, and he's one of our top producers who's been doing reverse mortgages for over 30 some years. And if you're interested in getting any information, Ted would be the great guy to talk to, because he could really give you all the square scoop. And like I say, it's not a sales job, it's education.
Yep.
Reach out. I left my email address. I'm going to put my cell phone. It's all in the chat. Be happy to answer any other questions you may have. Reach out to me if you're in another state. We've got offices all over the United States. I'm sure all of you have heard of Mutual of Omaha, 114-year-old company. We're a division of them, and that's who you're dealing with.
Marlon Perkins.
Marlon Perkins, and Wild Kingdom is coming back. It's going to be on TV here again, I believe on Channel 4 pretty soon.
Well, thank you, Tom, so much for your time today and this very attentive audience. We appreciated having you. And as I mentioned, this will be the recording and the slides and everything will be available on the YouTube, the IEA YouTube channel, which I put in the chat by the end of the week. So do look for that. And if you have any questions, please feel free to reach out to Tom directly. And we'll see you next month for the next IEA webinar. Thanks, everybody. Have a great day.
Thank you.
Thank you, Lisa.
Bye, everyone.
Right, thank you.